Hello, I'm Kevin Flynn, and welcome to another edition of Avalon's Market Minute. It's June 9th, 2013. Stock prices actually did slip a little bit last week. Despite the manly in-your-face rally on Friday, there was a carbon copy of the one on jobs report day a month ago. Markets like to do things like that. The report wasn't so great. Even the Wall Street Journal wrote that the jobs report was nothing special. It was average to below average, in fact, based upon the Labor Department's initial estimate of 175,000 new jobs in May. That's below the Fed's goal of around 200,000 per month. But in a rerun of last month, the private sector ADP payroll report 2 days earlier was again well short of expectations, which again reset market expectations for a disappointment from the Labor Department report, which came through again with an identical 10,000 jobs beat of the official consensus. A little bit of irony is that last month's beat may not have been an official beat after all, since it was revised down by 12,000. But markets don't trade much on revisions. They do on the initial headline. 175,000 result was right in the Goldilocks zone. Not too hot to scare the Fed into speeding up any plans for withdrawal. Not too cold to frighten the markets about growth, given that the rest of the economic data had been on the weak side. Stock and bond markets alike have become completely fixated on the next Fed policy move and what might happen with quantitative easing. It's become a somewhat ridiculous obsession and a problem that the Fed probably wishes it didn't have. Even so, it's likely to dominate the conversation on Wall Street in the weeks ahead. The next announcement from the Fed will be next week on Wednesday. When the Fed will start to taper or begin to reduce bond buying, and when it will give the next clue, is likely to be this summer's parlor game. The choices are focused on next Wednesday, or September, or December. It's possible that the market will fall back into its invincibility belief of recent months, namely that good economic news is good because it means the recovery is working. But bad economic news is good also because it keeps the Fed in the game. It's usually harder to keep that going during the summer, though, when the volume is thinner and volatility more common. Events from abroad might interrupt as well. In sum, Friday's report, however mediocre, did give the market some legs and had the usual list of suspects rushing forward to cast flowers at the feet of the economy and stock market, glowing about years of expansion and bull markets to come. Well, the rest of the data didn't bear that out, but the markets rarely like to think about more than one thing at a time. I'm Kevin Flynn, and thanks for listening to Avalon's Market Minute.